Hey, good morning, everyone. Marty Mazzora here, November 7th, 2019, Thursday morning. Wasn't going to take your time this morning with the video, so I'm going to keep this really quick, but I thought I should given the big rally that we're seeing once again today. Interesting developments in trade. Last night, futures pointing to what was going to look like a pretty ugly opening this morning. If the currency futures that instruct me in terms of what's likely in the short term, or at least the positioning of currency traders, was pretty much risk off. Money was rotating pretty aggressively from the more risk on um, currencies to the Japanese yen. And we've talked about why the yen is the funding currency for carry trades, and the regular readers and viewers might remember that, but I won't get into that this morning. But suffice to say that the yen is kind of the global safe haven in terms of currencies of late. So you look for movement there, and it's pretty instructive in terms of how the market's going to open. Then I took a look a little later on in the evening, and it completely reversed in the currency markets, and equity markets were rocketing higher on news out of China that the US and China had agreed to begin rolling back all existing tariffs. Now, that is dramatically in opposition to what the US has promised really from the get go once the tariffs were added, and that is that they would be long term. And even when we get a deal, I think that original 250 billion was going to stick around to keep China honest. So that's a big move, but that's a big change, and it's the kind of change that really, I think, justifies a really strong rally. The news this morning from the editor of the Global Times, which is China's state media, was that both sides need to give equally if we're going to get a phase one deal, and I hope the U.S. agrees. So that's different, and we haven't had any confirmation from the U.S. just yet, but the market clearly is discounting um, that is the case, that they're going to at least begin rolling back existing tariffs, not just delaying the December 15 scheduled new tariffs. So that's the kind of thing. And remember, all along in here, I said good trade news is what it's going to take. Now, the video I did day before yesterday, I said we're looking at 3,100 now as a nice round number of resistance. We did, no doubt, got some serious short covering this morning. So always remember, folks, some of these rallies on this kind of news and these gaps is not necessarily about a bunch of new money coming in. Certainly, that's probably going on. But the folks who shorted here, expecting that this wasn't going to hold these new all-time highs, and this is kind of a classic. Could have been a nice island reversal. I won't get into that either, but those are high probability. Once you come down off of that gap and you have a gap on both sides, those are high probability or high percentage losing scenarios. So shorts do real well in there. So if anybody was anticipating that, they got disappointed and they had to cover. So that's going to push stocks higher. But we've been, 30, 95, 74. So technically speaking, if you just woke up and all you were was a technician and you liked these indicators, nothing here of any real consequence, frankly. You still have your upward sloping wedge, and this is just the divergent line, so that can continue to move, and you're still in that wedge pattern if we break through there. Here you've got somewhat of a trend line, a little bit weak, but it is a trend line. So getting close to the apex up in here, so this thing's going to move, one direction or the other, certainly threatening big time. We just hit new all-time highs as I speak to break out of that. Beyond that, when we back up, we still have that same look. You have, back in here, you have something similar, right? You had a big correction, and you had the market meander. You had these divergences, these negative divergences down in here, and then you had the market roll over. Here you have the market going from here to here, another new marginal high. You've got these negative divergences. This one's breaking through there, but still definitely your negative slope off of here. You can notice here, this one broke above that as well a little bit. So, it's similar patterns. Again, if you're a technician, you'd say, there's just nothing here other than what we've been seeing the last 2 or 3 years. Don't let the pigeons loose just yet. I still have to say, though, that a legitimate resolution to the trade war, where we go back to the days where there were no new tariffs before the Trump tariffs on China. Um, and again, notwithstanding the longer term legitimate issues that absolutely need to and have to be addressed with China, intellectual property theft, for example. Those are real legitimate concerns the world over and need to be addressed. Tariffs going in, most economists who aren't, politically attached would tell you that that was, history has proven over and over again, that's not the way to do it. I think the global economic data over the last year or so has proven that as well. And maybe, the powers that be are getting that message. Maybe not. Time will tell. I think we would all agree that the political incentive to go back to the pre 2018 tariff regime is huge, and particularly for the US. So we'll see if that happens. The big overwhelming question is slowing global economy, global manufacturing really in recession. There's no argument that it's not at this point. The global consumer in the US, for sure, I said the global consumer, the US consumer is in good shape. Services sectors look okay. Pockets of strength in certain areas. Ending the trade war here, does it bring back animal spirits? Will we really kind of re-engage the U.S. with the rest of the world, and embrace multilateralism again? That's what the global economy, that's what big multinational U.S. companies are asking for before they really engage in the kind of expansive activities that would look good and bring this economy back on track and get back to my thesis a year ago, where we had 2 or 3 years left in this expansion. Not my thesis today. It can't be, given the underlying data. And then, folks, remember, under the surface, and I'm going to continue to throw more and more of this data at you, only because you clients out there, I want you to understand why we remain guarded right here, and I think why we have to until some of these skies clear. First of all, just in terms of momentum and trends, and to what degree we want to be, exposed with all the risk of the stock market, we've got to see, the capital expenditures. We've got to see some of the more mainstream headline surface data improve, and give us the signals that recession risk is waning. Right now, our own index says it's heightened. That would get us to either lessen our hedges or take them off altogether, perhaps, if we've got some really good positive momentum in that direction. We are going to have to be very, very smart, very thoughtful, and very attentive to the underlying corporate debt market. I can tell you this, that it looks a lot like the mortgage-backed security market, the where the consumer was in 2006-7, leading into the 2008 disaster. But it's all in the corporate sector, and there's too many similarities and too many fractures that are now beginning to widen down there that could morph into something really ugly. This great news on trade, if indeed it is great news on trade, also can put pressure on that scenario, because it will ultimately put upward pressure on interest rates. Bonds are taking a hit right now. Upward pressure on interest rates. When you look down below the surface and you look at all this, what I'm going to call subprime corporate debt, excuse me, as that debt comes due, and as they need to perhaps issue new debt, because I hope we're not getting to the point where you have to issue the new debt to service the old debt. In some places I suspect we are. And then all of the activity that's going on in the private equity market, the leveraged loan scenario is a scary one. And it's inside these collateralized loan obligations. Remember, back in 2008, it was collateralized mortgage obligations. So same animal, just different things inside of it. That activity is very robust, and there's just a ton of it, to the tune of billions and billions going on as I speak. Tightening of conditions with higher interest rates is really going to put the squash on that. And that has implications in and of itself. And by the way, a senior loan officer survey that just came out this last week does show that banks are tightening. So banks are beginning to, I think, see and feel what we are seeing and feeling. And they're beginning to tighten down a little bit, batten down the hatches, if you will, on at least corporate lending standards. So We'll see. So you clients out there, yes, with our hedges, remember, we are participating to some degree. The first few points to the upside, and then we're going to flatten out for a while. And then if this continues to rock higher, we will catch all of the moves, above a certain level. So we're not out of the market. We've just muted the gains at a certain level, at a certain move, and that's to pay for the protection that we have underneath. Those of you in taxable accounts, if indeed we get to the end of this and the market went up, and that is the best scenario, market went up, our portfolios went up, our option callers went down, they had the offset, it's kind of like a bookkeeping entry, but when we unwind them, we do have a tax loss. Even though the portfolio didn't go down, we do have a loss that we get to book that we can use now and in the future to offset the taxes when we do the rebalancing. That is a significantly better scenario than if we would have just acted on our thesis and sold equities. Actually, in many cases, created taxes when we did it, and be out of the market entirely and not really be able to define the risk as we have to the downside with the options. So anyway, of course, you clients, when you come in for your reviews, will be able to explore all that on an individual basis. Again, best thing in the world would be for the markets and for your portfolios, frankly, would be for this to continue, but it needs to continue in a healthy, holistic, for lack of a better term, fashion. That's not what's happening. Right now it's continuing on noise around trade, rhetoric, the Fed that's promised to be there till the end. Nothing about fundamentals. Valuations are historically high. Stocks are overvalued by many metrics. Earnings projections are lower. Earnings guidance is lower. And the debt situation, corporate balance sheets, debt service responsibilities, interest coverage, all these kinds of things are just deteriorating by the day. So notwithstanding this nice rally in stocks, folks, under the surface, there are some things that we remain very, very concerned about. And on your behalf, you clients, we have to continue to accommodate for that. And now I'm going to leave it there. Thank you, as always, for watching and listening. Watch for the weekly message. It's going to get to you today or tomorrow. I'm going to talk about the risk of greed and where it shows up, and leverage some of Warren Buffett's favorite sayings. Have a great day. Thanks. Bye-bye.